It's time to stop throwing away money and get a hold of your finances. All right, so if you want to grow a massive business and be able to know where your finances are going, I'm sure you've finished a job and been like, where'd all the money go? What's happening? Why don't I have money in the bank after doing all this work, putting in all this effort? So I'm going to be going through 6 or 7 different things that you can be looking at to manage your finances properly. Make sure you're putting more money in your pocket. Then at the end of the video, close to the end, I'm going to be sharing with you what an actual health check dashboard looks like. So this is a dashboard that just shows you in a quick view exactly where you are at financially and why just looking at a profit and loss statement is actually not going to be as effective and really kind of muddies the water. You don't get the full picture of what your finances are doing just by looking at a profit or loss or running your general report. So I'm going to be sharing that with you. Before we get started, give this video a big thumbs like up. Super appreciate you for doing that. Best way to grow your contracting business, subscribe to the channel. All right, so first thing we're going to talk about is overhead, and it's so important. It's something that is kind of mentioned a lot. So a lot of people figure that I know what overhead is, I understand it, and we can move on to the next topic. But in reality, having a really good understanding of your overhead ties into your estimating and ties directly into the profitability of your business. Things that you want to be looking at is your burn rate. So your overhead every month, you're going to be spending no matter what you're doing. If you have 0 jobs or 100 jobs, you're going to be burning a certain amount of money every single month. And understanding that is going to be key to knowing, how your cash flow and finances are going to work over time. What you want to be doing is figure out your overhead. Look at the past 12 months of overhead that you've had. So whatever it is, could be 50,000, 100,000, 10,000, whatever it might be, divide that number by the last 12 months of revenue, and that'll give you the percentage of overhead that you are burning in your business. So ideally, it'll be somewhere around the 10 to 15%. If it's less than that, good. If it's more than that, that can work as well. It depends on the business. But generally, for most contractors, I would say 10 to 20% is pretty typical. And you have to remember that when you're factoring in things like your margin later, so if on an estimate, you're factoring in your overhead and profit. If your overhead percentage is, 10 or 15%, and you're only marking up your estimates by 15 or 20%, you're leaving a really small gap in between what you're paying in overhead to what you're actually trying to profit. And if anything doesn't go right in that project, that's where your money's getting burned up. And that's why you're not seeing the amount of money that you want to at the end of project. I've had this happen to me so many times running my own projects, doing my own thing, and realizing at the end, oh, I didn't, estimate or budget properly for this. And, why did I make any money? It's because your overhead was eating up a lot of it. And maybe you made a few mistakes. So all the profit's now gone, right? So that's why overhead is so important. That leads me into my next topic here is the estimating. So second point here, estimating. For estimating, the big things that you want to be looking at for financial management is your labor rates. So this is another one where it's really easy to not realize where your money's going or why you're not making as much money as you should be. And it's usually often in estimating is because you've undercalculated the amount of labor that you need for a project, but also your labor rates are not in a good place. So quick test to see if you have a good labor rate is generally whatever you're paying your employee, you should be charging double that to the client. So let's say you're paying carpenter $30 an hour, you should probably be charging out probably around $60 an hour for the actual estimate that you're doing, plus your overhead markup on top of that. So if you got $60 an hour that you're charging, then you got an extra 25% or whatever that you're marking up your estimate. That is how you should be figuring out your financials on the estimating side. I've got another video exactly how to figure out the specific labor rates for different jobs and make sure that you're attributing all the actual costs of an employee into your labor rate. So go check out that other video after this one, and you can get a very exact, labor rate to make sure you're not losing money on that. Another one on estimates for financial management, where I see a lot of contractors not understanding exactly how to mark up or, add project management time to an estimate. And this is really important because you want to be attributing a certain amount of hours for management to a project. And this will get you in the habit of thinking, how much time am I going to be spending on management? It also make sure that you're breaking that out in your estimate so that you've properly attributed a budget, an estimated amount to project management. If you're the only person, managing projects right now, and you're just like, I just mark it up an extra 10% or 15% for management here and there, you really have no idea, and less time on larger projects, and it's making your smaller projects probably more attractive to clients, than your larger projects, because as a percentage of the project, the larger the project, generally the management time is going to be less as a percentage of the project. Getting a little advanced there, but if you understand what I'm saying is on smaller projects, you're actually going to want, it's going to be more expensive because you actually realize how much time you're going to be putting into a small project as opposed to a larger project. Let's say, if you're doing like a $15,000 kitchen reno, the amount of management time for that as a proportion to the sale price is going to be much greater than, like a full home, let's say $1 million home build. The project management that you're going to charge the client is going to be less of a percentage of the overall project. So hope that makes sense, but it's really important and really a key factor into making sure your financials are running properly. And then miscellaneous. So add a little bit of miscellaneous into your estimates. If you don't want to put the actual like item on the estimate that you have as like miscellaneous because you feel you're going to get, pushback or feedback from a client, just kind of either have it as, kind of mixed in with something else or have it as like a cleanup or, site maintenance fee or whatever, that you have something like that. But have a little bit of buffer, have a miscellaneous materials and a miscellaneous labor just to make sure, because as you know, every project there's going to be something that you didn't account for or that, you need extra material or a little bit extra time to get done. So really important. Estimating is huge. You make your money in contracting when you estimate. It's not when you actually go build the project. Yes, that's when you get paid, but the actual money that you make is when you estimate, because if you estimate it properly, then when you go to actually produce the project and get the work done, that you've set yourself up for success and you've set the pricing right, so you're going to make money. So estimating is a really important component to proper financial management in a construction business. Is this making sense to you? All right, so moving on. There's a bunch of points here. Each one's going to feed off the next one, and it's really important to get this down. I know it can be a little bit tedious or, maybe just number crunching and maybe you're like, well, I just, want to go out and produce and get sales done. And there's like all these other ways to grow a business, but getting the financials right is so important because it's part of scaling. It's part of being financially healthy, part of weathering that storm of ups and downs. If the economy goes down or you're low on leads or this or that happens, having proper financial management, it just puts you in a really healthy place and make sure that your business is going to last, decades and decades, and you'll be able to get that growth over time. So third thing I'm going to be talking about is job costing. So no contracting business would be complete as far as the financial management side without proper job costing. And it's one of the probably last things that I see a lot of contractors try to set up as far as their financial systems, because it's a little bit difficult to wrap your head around and to implement, even though the steps in the process aren't anything too complicated. It takes a bit of fine tuning and things like that. So first thing to get in place is cost codes. You can go get the National Association of Home Builders cost codes or the CSI cost codes, depending if you're residential or commercial or which one you want to go with. I'm not going to get into that. I've got other videos on cost codes. It's really very easy to get cost codes set up in your business. If you're using a project management software, then it should have built-in cost codes of those two that I mentioned. I wouldn't use the program's cost codes itself. I find they're not really that great. Use one of the standards would be my suggestion. So, and then having some tracking software, and then you want to be checking your budget versus actual. So I'm not going to go into the setup of job costing. I've got other videos on that again, got a lot of videos out there, but the budget versus actuals is what you want to be checking out, because that's going to tell you where you're losing money and where you're making money, and how to have that cycle of feedback of like, okay, we completed this job. It seems like our framing is always going over. Whenever I budget, 2-3 weeks for framing, it always seems to be 4 or more. So now, when I'm estimating, I need to be adding extra time for the framing or whatever it is, right? So you can easily see that. Or it may be like, demo. Actually, we always crush the demo and it's, done super quick. I usually budget like twice the time it's actually going to take. Maybe I can tighten that up a bit, so it just really helps you fine tune, be more competitive, but also be more profitable at the same time. So that's why job costing is so important to proper financial health of a business. Is this making sense so far? Drop a comment below. If there's anything that you need more help with or want, let me know. I've also got a spreadsheet and different things like that. So drop a comment if you'd like me to give you some extra little templates, digital assets, as I mentioned, and those can really help you. So moving on, number 4, we got budgeting. If you're like a lot of contractors, you probably never actually run a proper budget. You may know it kind of like what you spend here and there, but the part budgeting, I would say you do it annually, at least once per year, and then you want to be checking it throughout the year. But a budget is fairly simple. It's pretty much just being intentional. So getting from your head onto paper of like how do I want my finances to look? So instead of like, always checking historical figures of like your profit or loss, your balance sheet or whatever, those are all like historical. They're in the past. You can take that information and make, future changes, but you can't change it once it's been done, right? A budget helps you project forward and plan, this is how much I want to spend on things. This is what makes sense as a company so that we can operate properly. And that's why you want to be setting up a budget. It's very simple to do. And you just take your chart of accounts like you'd see on a profit and loss statement and just put percentages for everything that you have. So marketing expense, let's say 2%. Whatever it is, in your items, just put percentages and does it add up? And is that an amount of money that you can run as a profitable business? So if you want to keep your overhead, instead of like realizing, oh, my overhead's like 20% or, something or 15%, I want to tighten that up. With a budget, you can do that beforehand and be like, I want to stay at 10 or 12% overhead. So, where are my expenses? What do I not need to spend money on? What do I need to spend money on? And then, like quarter or halfway through the year, you can check, okay, marketing and advertising. Wow, I've spent like 5% of my revenue on advertising when my budget is only 3. That's going to be an issue. I need to, maybe tighten things up or figure out a better way to do the same marketing on less of a budget. So budgeting, again, it just really helps you project forward of how you want your company to run and the allocations of percentages for your different expenses. So moving on to number 5, one of the most important, and I've got 6 and 7 coming up. And like I said, at the end of the video, I'm going to be sharing with you an actual like setup of what a financial health check dashboard looks like is what I call it. And this just gives you all the key metrics. I've got, your 2 big metrics and there's 3 key metrics with the trailing 12 months. And it's a little bit technical. That's why I want to show you, but it's really important because if you can set that up for yourself, you can just quickly look, it takes maybe a couple minutes a month to just take a quick health check. And it's like, you can just, wow, this is going really good. This is not good. How do I change it? So stay tuned for that. Number 5, cash flow. Cash flow, so pivotally important inside a construction business, as you know, making payroll, paying subs, paying for materials. If you've ever been short on cash flow, you know how painful this can be. I've been there, filling up my truck and looking at my bank account, and it's like trying to scratch, some bills or some dollars together to pay it because I spent all my money and my cash flow was bad at the time. And, I've been through that pain and it really sucks. So having good cash flow is so important to a healthy business because without good cash flow, you end up stressing yourself out a lot and it affects your performance and your business. But it also just puts you in a bad spot financially where you maybe have to take on loans or you're working on financing or, you damage relationships because maybe you didn't pay on time for, this contractor or your material supplier, what have you. So cash flow, it can really be a detriment to your business if it's not managed properly. I'm sharing with you 2 things on cash flow. The 2 big things is getting deposits. So get a deposit early. If you've got certain laws that prohibit you from, getting a decent deposit before the project starts, then look at invoicing really early and just have like a site mobilization fee or material purchase fee or whatever to get a chunk of money at the beginning of a project. You want to be able to the client should always be paying for their project. So let's say you've got $100,000, reno and you've collected 20% deposit, so you got 20 grand. Before you spend $20,000 on that project, you should be invoicing the client again so that you've got another chunk of money to be pulling from. There's a few reasons for this. One, it always enables you, it limits your risk because you don't have to worry if the client's gonna be slow on payment or, putting out your money and things like that. It also helps you scale or grow. So as you know, like during times of the year, you may have a bunch of projects, you may have less. If you need to take on a bunch of projects, you get a whole bunch of work coming in. If you're financing those projects out of pocket and you've got to put a bunch of money into each one, your cash flow gets, evaporated really quickly and you get a cash crunch. Even though you got a lot of business out there, you're doing a lot of work and your revenue may be good, but your cash flow really suffers in times like that. So by getting deposits and payments early, it gives you that buffer and gives you, it's the client's project. They should be paying for their own project and they should be paying you before you purchase materials, before you put labor into project. And if you're doing a commercial project, I understand commercial builders may, have limits to this. They may do, 30 days or 60 days, payments and things like that. A lot of them, if you talk to them, there is ways possibly around that or ways to get paid sooner. So really just have that conversation, play a little bit of hardball and just let them know that, you can't essentially, just put a whole bunch of time and labor and materials into their project without some sort of payment in a speedy way. So have that conversation. And then the second point I'm going to mention with cash flow is invoice more regularly. So have a system set up, hire an admin, hire somebody, get one of your people that are already doing it. You need invoices to go out every 2 weeks at the minimum. I would say you should be invoicing every week, but at least every 2 weeks. And again, the reason for this is cash flow. It also helps the client or whoever is paying for the services because they have smaller payments, right? Instead of having, let's say, a $50 or $100,000 draw on a project, you could break that out into maybe they're just paying like $10,000 or $15,000 every week or 2 weeks. So it's a lot easier for them to pay. And if you're worried about that they are going to have so many payments and it's going to be confusing or whatever, a lot of work. Once you have the system set up, it's really not, and you should be able to have a way to collect payments, bank transfers, and things like that. It's fairly easy nowadays that it takes a couple seconds to forward a payment. But what this does is gives you excellent cash flow and puts you in a much better spot. And you know that you don't have to like push and rush and like try to get these big draws on project or reach certain like milestones and things like that to get paid. At the very least, shorten that window of invoicing and set up your contracts and the expectation with the client ahead of time so that you can essentially do that throughout your project. So I'm making sense so far. This is where we come to the kind of the final point I'm going to make here. Stick around. Like I said, I'm going to be sharing with you that dashboard after this. But the Profit First system, if you haven't heard of Profit First, it's a book by Mike McCallowicz. Essentially, what you want to do is, again, it works on allocations, but you're going to set up 5 different bank accounts. And this is a really important piece of managing your finances properly. But set up 5 or 6 different bank accounts. Again, you can kind of fine tune this to the way you like it, but essentially you're going to have a revenue income account. So all your sales, all your revenue goes into one account. And then from that account, it gets split out into your other accounts based on allocations. So let's say you've got, $100,000 in your account from different projects that came in. Now you're going to allocate that. So generally, for taxes, you're going to want to set something aside. So you're going to have a tax account and again, it's going to depend on your business and where things are at. But let's say, 10% or 15% of your revenue goes to paying taxes. This could be your remittances for, employees. This could be your personal taxes, corporate taxes, whatever it is. That's going to be your tax account. So 10 to 15% go into that account. You can have another account for your expenses. So this is operating expenses. This is payroll, materials, overhead, anything that you pay out from your business. You're going to have an expense account. That could be anywhere, maybe 60, 70% of revenue goes to expenses. And then you're going to have your owner's draw account. So this is your personal account, or if you've got partners, it would be for multiple people. But this could be anywhere from 10, 20% or more. Again, you've got to adjust these depending on your business. And then you're going to have a profit account. This is key. So whatever you want to have in profitability, that'll be another allocation. So if you want to have 5% profit from your company, 5% of your revenue is going to go into that account. So what this does is, without having to look at your books or financials or anything else, you now have allocated your money into your different accounts by, again, being intentional of how much you want to spend and what business can afford. So if your expenses are getting really low, then you know that, hey, I've got to adjust my allocations. Either I need to take a salary cut or a profit cut or something else, or I need to figure out why my expenses are so much higher. So it alerts you to issues in your business, and it also kind of gives you just a better picture of exactly where you're spending your money and what's happening inside your business. So now we're going to move on to the dashboard spreadsheet that I want to show you. Okay, we have the dashboard. I'm going to be going over some of the key metrics that you want to be looking at and can help you just get a good financial health check of where things are at with the business and help you create better decisions long term so that you are staying profitable and you're actually making money at the end of the day, which is not the full sole purpose of your business. Purpose is freedom, flexibility, and purpose and everything, but finances are a big part of that. So I'm going to be going to the data and some other like key metrics of where this comes from and how to be thinking about this. But essentially, your revenue is something that you want to be looking at, and your profit, obviously keeping track of how much revenue you're making, how much profit. All of this information is it's trailing 12 months. So what that means is that in May here, the previous 12 months, this is just fictional numbers. This is not, a real company or anything, but this is example data. $948,000 is the trailing 12 months revenue. April, it was, 868,000. So you're always adding that last 12 months into the actual data point for that month. What that does is if you look at your profit and loss statements, even month by month, you'll see like it'll go up and down a lot, right? So, one month you could be, revenues could be 200,000. Next month it could be 15,000, depending on when you got paid and what's things going on. Hopefully it's more consistent than that, but you know what I mean? Things can go up and down quite a bit depending on a lot of different factors month to month. With the trailing 12 months, it helps sort of even things out and gives you like a wider angle, a better window of actually where things going. And then you've got this line here that kind of gives you the trajectory. So we can see, revenues are increasing, even though that they've kind of gone up and down, and now they've, spiked again. You can see, like this was kind of late last year, so we finished up a bunch of projects. Then maybe December, January, February, things are slower, so it starts to dip and then it'll pick up again. But the overall trajectory is revenues are climbing and heading, in the right direction. So you can also see that the profitability really in this example, based off of a real company but not actual numbers, is very much tied to revenue. It may be different for your business though, but when you do this picture of 12 months, you'll see those correlations a lot better than if you're just like 1 month, again, if you just purchased a bunch of stuff or you didn't get invoices out on time or whatever, your profitability can go up and down significantly month to month. Whereas if you're looking at the trailing 12 months as data points, it kind of even things out and shows like, hey, we're actually becoming more profitable faster than our revenue is climbing, which is great. That means, things are definitely going well. That's kind of the first graph that I've got. The second graph that I've got here is percentages. So the yellow line is overhead. And this is another thing you should be tracking is your overhead. Is it going as a percentage of revenue up or down? In this case, we can see that it was up at 30% because there was really low sales and revenue had a really bad time with the business, middle of last year for whatever reason. So overhead as a percentage of revenue was, very high. Even though your overhead expenses may be staying about the same, you don't really know as a percentage, is it a higher percentage, lower percentage? And the reason this is so important is because going back to your estimating, if you're estimating, overhead markup as 20, 30%, let's say, and your overhead right now is 30% of your revenue, well, you're not going to be profitable. You're going to lose money on that job unless you've over budgeted somewhere or what have you. But generally, that's not the case, as you know. So that's why this is so important. And you can see in this case, as the revenue kind of evens out and climbs, the overhead comes lower as a percentage. And maybe, because of this here, things got trimmed and brought the overhead. So there's two factors going on. The other one is your profitability percentage. So you can see profitability is really low this time of the year, probably because there wasn't projects at the time or what have you. It climbed, 20% profitability. That's amazing. That's awesome. And then it kind of evened out to more what you sort of expect in a construction company, somewhere just below, 10%. And then there's this big spike in May. So that's great to see. And then the final thing that I've got on this checklist here, if you want help setting something up like this, drop a comment below. I'd be happy to help you with this. And we've got stuff like this for our clients, is the client acquisition expense. So this is all the marketing and sales expense of what it costs as a percentage of revenue to acquire clients. So we can see here that it was around 3%, and then it's kind of trailed off to maybe about 1% to 2%, So that's great to see that as a percentage of revenue, the cost of acquisition for a client is lower as a percentage. So things are going well. And maybe there's room to improve and spend more on advertising sales because we know that it's been dropping. So maybe we want to boost it up because we've budgeted 3%, let's say. So we could then spend more on our marketing, bring it into 3% of our revenue and, bring in more clients and grow the business essentially. So it gives you that kind of overview of data. That's really the key metrics to make decisions for the different parts of your business. So does that make sense? Right on. So the data set, it's going to look something like this, and that's all sort of mostly automated, or you're plugging this in from your financial tables. But once it's all set up, it puts it into an easy to read format with your graphs and stuff like that. Another key thing I want to mention here is your acquisition costs. So this is a really pretty straightforward kind of calculation. If you haven't done this before, I would suggest after this video, go run this cost and figure out what does it cost you per lead? What does it cost you per client? That'll tell you how much you can spend on advertising, if you're spending too much or not enough or what have you. So you put in your advertising, your marketing, any kind of sales, if you got sales staff, referral fees, anything that
costs you to bring in clients for advertising, marketing, and sales, essentially. So you're going to put that in there. This is going to give you your total client acquisition cost expense. So you're going to get an expense for that. Then you're going to want to put in your qualified leads. So hopefully you've got a CRM and you should be able to go like past 12 months or, trailing 12 months. How many leads came in? Like qualified leads that you actually did like an estimate for. If it's unqualified leads, I wouldn't put that in here. You could if you want, but essentially these are leads that they actually picked up the phone, you actually talked to them, and you actually provided a proposal because they were a good fit for your business. So in this case, we got 76 leads. How many of those turned into sales? So how many projects did you actually do in the trailing 12 months? In this case, it was 18. So now that we've got those numbers, we can easily see it's costing us about $200 for a qualified lead that we provide an estimate for. It's costing us about $200 for the actual amount of clients we get. So for every job, we're spending around $820. Of course, this is like on average, but $820 of marketing, dollars and sales dollars that we spend, we get a client. So from this, you can then figure out as a percentage of revenue, which we had on the other graph already. So we sort of know that. Also figure out your closing percentage. So this kind of lets you know like, hey, if I provide 10 estimates to people, I'm probably going to get about 2 to 3 sales. And you can track this again. So, if your closing is better or worse, or, sometimes clients and myself too, where it's like, man, it seems like all the leads I'm getting are just crap, right? They're all just shit. Like for whatever reason, it's like tire kickers or they're not going through or whatever. This will alert you kind of like, is this just like my own perception or is it actually what's happening? And this will tell you, your closing percentage and how it's changing over time. From this, you can also set your goals. So if you've done about $1 million in sales this year, let's say next year you want to get to $1.5 million, which is, a big goal to increase revenues by 50%. That's, quite a few either larger projects or more projects. So, like in order to reach that goal, I'm going to need about 120 leads, right? So right now I had about 80. If I want to grow by that, I need about 120 leads. That's a difference of, 40 leads. I times that by 200. That's about how much more I can expect to spend on marketing. Of course, it's not always going to work out perfectly, but it gives you that kind of insight of like, hey, if I increase marketing or, this or that by this much, then I can grow my company.